Asian markets rally, shaking off the worries on Wall Street as the S&P 500 falls into correction territory. Germany's public sector strikes intensify, with healthcare workers joining ongoing walkouts. And we'll also dive into Malaysia's AI ambitions as the government seals a $250 million deal with a leading chip designer. Hello, I'm Oscar Subakti with the latest business and finance news here on TRT World. Investors in Asia have been defying the gloom on Wall Street, with Asia-Pacific markets mostly rising despite a plunge in all three US benchmarks. It caps off another turbulent week for global stock markets. Mainland China's CSI 300 reversed losses from the previous session, surging almost 2.5%, leading gains in the region. Hong Kong's Hang Seng also rallied, rising just over 2%. Overnight on Wall Street, the S&P 500, Dow Jones and Nasdaq all lost ground. It comes after Donald Trump ramped up his tariff threats, warning of a 200% levy on alcohol coming from the European Union. That's in retaliation to the EU's duties on American whiskey. Meanwhile, safe haven assets like gold have been beneficiaries of the escalating trade war, with the precious metal climbing to a new record high of almost $3,000 an ounce. Well, let's go now to Josh Mahoney in London. He's Chief Market Analyst at Scope Markets. Good to have you back with us, Josh. Wall Street's benchmark S&P 500 closed in correction territory, but Asian markets are higher. What's behind the positive sentiment there?
Well, it's quite obvious that right now we're worrying about a potential recession in the US. That isn't necessarily an indication that we will see a recession everywhere in the world. And so investors are certainly fleeing to other regions. One of the sort of things that underpinned the strength of the US market has been the AI trade. And everyone thought that with NVIDIA behind them, the US was essentially going to be the be all and end all for AI. We've certainly seen that undermined with a number of Chinese names coming out with impressive results. So we're seeing people trying to find value elsewhere in the world. Overnight, we also saw the PBOC coming out saying that they are willing to stimulate the economy further. So there's a feeling that the Chinese economy could be on the way up after a difficult period. And from low valuations, currently the Hang Seng's are around 15 price to earnings ratio, whereas the US markets are on the way down, with people thinking they're overvalued given the huge amount of uncertainty in play at the moment. The price to earnings ratio was at 27, now at 25.
Now, Josh, this would be the fourth negative week in a row for the S&P 500 and Nasdaq. Tell us more about why Wall Street investors are still jittery, and do you expect that turbulence to continue?
Yeah, one of the things that we thought when Donald Trump came into power was that he had all of this rhetoric around being sort of tough on other nations and the willingness to implement tariffs. And it felt like he had a number of positives, but the negatives were largely disregarded because we thought that if the market fell, he would probably just turn around and reverse them. He's done quite the opposite. It feels like we haven't seen much positives, and all we've seen is him being willing to push through with the negatives. And there's a feeling that right now he doesn't care about the markets. And so he's going to do whatever it needs to be done for him to essentially recalibrate the economy. He said it could take some time. So now, himself included, but people are really speculating that this year could be dominated by economic difficulty, and that really pushes capital out of the US and into other regions. Europe's been doing well, Asia's been doing well, and right now we've got a huge amount of uncertainty, and certainly markets don't like uncertainty, and that's exactly what's playing out. So it's difficult to know exactly when we will get certainty.
Meanwhile, gold has hit another record high. It's just under $3,000 an ounce. Do you think the safe haven asset will continue to rise, and how much higher could it go, do you think?
Yeah, what's interesting about gold is typically it falls at the time that the markets are falling quite sharply, and that's something we saw recently. It didn't outperform as markets were selling off heavily at first, but generally people then start to take a look around when they've settled a little bit, and that's when they get into gold. That's exactly what's happening now. There's a feeling that with the fact that the tariffs from the US look likely to stay for some time yet, people aren't necessarily desperate to put their money into US assets. Bond yields are falling, so they're becoming less attractive over in the US. And so this as a haven play does make a lot of sense given the huge uncertainty that's playing out within US markets and the US economy at the moment. So I certainly wouldn't be calling a top on gold right now.
Okay, Josh Mahoney, great to get your thoughts as always. Thank you. Well, as the trade war between the US and European Union escalates, Spain's agriculture sector is bracing for yet another crisis. With Donald Trump imposing a 25% tariff on imported goods, Spanish olive oil and table olives could take a massive hit. The olive oil industry alone could face more than $1 billion in losses, making the US market increasingly uncertain for Spanish producers. Jaime Velasquez reports.
In Madrid, olive oil producers gathered to showcase their latest products. After 3 years of poor harvest due to drought, this season finally brings hope. But a major trade dispute with the United States threatens one of Spain's most valuable agricultural exports. The Spanish olive oil industry is in crisis mode, caught in the middle of a larger trade war. With billions at stake, Spanish producers are searching for new markets, but many say they cannot do without the United States. The Trump administration has announced a 25% tariff increase on imported goods, which could put some $3.5 billion in Spanish exports at risk. Spain exports around 180,000 tons of olive oil to the US each year, making it one of the most valuable overseas markets for the sector.
The truth is, we still don't know how this is going to play out. We don't know how the US market or the consumers are going to react. It is clear prices will go up, but I hope they will keep buying.
Spanish exporters may also be forced to lower prices to remain competitive, which could hurt producers and small farmers.
In the end, the tariffs may contribute to even lower prices paid to the producer. There has been a quite good production this year, but it is important that farmers get a fair price for their harvest.
The impact of these tariffs won't just be felt in Spain. US companies and consumers are also likely to pay the price.
There's a lot of concern over the new tariffs that may come into play in the olive oil industry, and we're very concerned because ultimately it's the end user that will likely suffer because the prices are likely to go up.
US importers are now preparing to lobby Washington to reverse the tariffs before they take effect.
We're all hoping to put our heads together and work intelligently and try to lobby against these tariffs.
In response, the European Union has announced $26 billion in counter tariffs on US goods, targeting American whiskey, motorcycles, and food products. Experts say this is part of a larger strategy to push the US into negotiations.
The main aim of this measure is rather to push the US administration into negotiation to try to reduce and solve this situation.
But for Spain, the agricultural sector is particularly vulnerable to these trade tensions.
The industries that are mostly impacted are those of semi-manufacturing goods and capital goods. However, another sector that also faces a lot of challenges is the agriculture sector, especially as like the role of the olive oil, one of the key agriculture exports of Spain.
As the April 2nd deadline approaches, Spain's agricultural sector is hoping for a last-minute breakthrough to prevent consumers on both sides of the Atlantic from paying the high price of a trade war. Jaime Velázquez, TRT World, Madrid.
Foreign ministers of the G7 major industrial countries have been meeting in Canada in a show of unity after 7 weeks of trade and geopolitical tensions sparked by Donald Trump's policies. Canada's foreign minister says peace and stability were at the top of the agenda at this year's G7 summit, at a time when Trump's trade and foreign policies have thrown the bloc into disarray.
What we have learned altogether in these shaky geopolitical times in 3 years, that especially in moments when your heart is really beating, it's important to keep a calm head. And we have been through these times all together, especially as G7. This was a powerhouse in the last 3 years, for freedom, for our common understanding of peace.
Well, Trump claims the global trading marketplace is unfair and that the US has been exploited by other countries for decades. Thomas Warwick is a former Deputy Assistant Secretary at the US Department of Homeland Security. He says the biggest problem businesses face right now is uncertainty.
The United States finds itself in a whole series of trade disputes with many of the countries that Americans thought were our closest friends around the world. We have deep and close economic ties to Canada and Mexico. Cars go back and forth across the border as they're built. Trade with Europe is also going to be significantly affected. And so there will be economic consequences. It's highly speculative as to whether the benefits that President Trump has described will actually show up anytime soon. The biggest problem for businesses is uncertainty. They could cope with a particular tariff regime and make their economic plans and hire workers accordingly. But when Trump announces a tariff one day, Canada announces a retaliatory tariff the next day, Trump changes his mind, the Canadians change their mind. Business leaders privately have come to Washington and told every one of us that, look, this is a real problem for us. And then when we say, are you telling this to the Trump administration? All of a sudden they become very quiet. And so publicly, all economic leaders in the United States are very concerned and don't see that this is going to work out for the better anytime soon. But the hope is that at some point we will get back to normal relations. No one knows, however, when that will be.
Germany's public sector strikes show no sign of slowing down as healthcare workers staged another walkout on Thursday. Since January, strikes have hit hospitals, public transport, schools and waste collection, disrupting services in all 16 federal states. Each week, different sectors have been staging new walkouts lasting from hours to several days. The trade union Verdi, which represents 2.5 million workers, is demanding higher wages and better conditions as inflation drives up living costs. With no agreement reached, more strikes are likely in the coming weeks. TRT World's Salman Ahmed sent us this report from Berlin.
It's strike time once again in Germany. Healthcare workers from across 200 healthcare facilities and hospitals in Germany have walked out of their jobs for 24 hours. Now that's 600 doctors and nurses just here in Berlin. All non-emergency medical procedures and surgeries have been postponed. However, emergency departments in hospitals will continue to function. All surgeries to be carried out on children and transplant operations will carry on as per schedule. Now, Verdi, which is the largest trade union here in the country, is demanding 8% rise in pay packets and 3 extra holiday days. Now, the German government so far rejected their demands, but over the last few years, Germany has seen a rise in such public workers' strikes, from transport workers to healthcare professionals, and even in cases, emergency workers. Inflation rates in Germany have been particularly high, sparking the need for many of these public servants to ask for a raise.
Well, let's bring in Ben Aris now, who's the editor-in-chief at BNE IntelliNews. He joins us from Berlin. Really good to have you back with us, Ben. As well as the healthcare sector strikes, we saw earlier this week massive strikes in the aviation industry with hundreds of flights cancelled across the country. Of course, workers are asking for higher wages. Do you believe Germany is currently in a position to be able to meet those demands?
It's struggling. The economy is not particularly third year of recession, and the government is scrambling, trying to boost growth, and it's got a hill to climb in front of it. That the things have changed fundamentally thanks to the war in Ukraine, thanks to the ongoing lack of competitiveness in the German economy. There was a report by the former Italian Prime Minister out at the end of last year saying that the chronic underinvestment that's gone on for decades has left the whole of Europe, but Germany in particular, struggling to keep up in the global race, the global competition. And this is a fundamental problem that Germany has to face. And on top of that, the war in Ukraine has meant the end of cheap Russian gas, cheap energy, and it's inflation. And that's the problem, is that the cost of living has gone shooting up, but the economy is stagnant, and that's affecting the quality of life. And so you're seeing these people striking because their lives are becoming more difficult, more expensive, but at the same time, wages are not keeping up because simply, there's not the work, there's not the money to pay those wages. So, I mean, the government's sort of been backed into a corner and is trying to solve all of it.
Yes, and on top of that, Ben, we have Donald Trump threatening tariffs on the EU, including Germany. Germany, as we know, is the world's third largest exporter. The central bank chief in the country is warning that perhaps Germany could be tipped into another recession this year because of those tariffs. Do you share those concerns? It looks like we've lost that connection to Ben, unfortunately, but that was Ben Aris from BNE IntelliNews. Now, a quick look at some other top business stories from around the world. A new corruption scandal has hit the European Parliament after police raids in Belgium and Portugal targeted lobbying for Chinese tech company Huawei. This follows the so-called Qatar-gate scandal from over 2 years ago, where lawmakers were accused of helping Qatar and Morocco. Although no lawmakers were detained, Belgian media reports that over a dozen are under investigation. The British government will increase its export credit for weapons manufacturers by $2.6 billion to boost overseas sales. This will raise the UK Export Finance Agency's total lending capacity for defence to $13 billion, creating jobs and supporting economic growth. The move comes as Britain, like other European countries, seeks to strengthen its military production in response to Russia's aggression. The US Export-Import Bank has approved a $5 billion loan for a delayed LNG project in Mozambique, allowing Total Energies to restart development. The loan replaces a previous $4.7 billion agreement made under President Trump, which was paused in 2021 due to unrest in the region. This clears a key obstacle for the $20 billion project. And Spirit Airlines has emerged from bankruptcy protection after finalising a debt restructuring plan. The company is looking to shift its business strategy after years of heavy losses, aiming to rebrand itself as a premium airline. As part of the deal, Spirit secured a $350 million investment from existing investors and converted $795 million of debt into equity. Malaysia has been quick to get on the AI bandwagon. The Southeast Asian nation is investing hundreds of millions of dollars in a new partnership with the chip designer ARM to enhance local production of crucial semiconductors. Emre Boz has the details.
Artificial intelligence has taken the world by storm, and countries like Malaysia are racing to harness its potential. The nation recently struck a deal with chip design company ARM. Under the agreement, Malaysia will pay $250 million over 10 years to acquire the firm's chip design blueprints. The goal? To upskill local producers and boost domestic know-how.
Through a comprehensive partnership with ARM, we have conceived one of the most ambitious technological plans Malaysia has ever seen to pioneer made by Malaysia AI chips. These chips will be designed, manufactured, tested and assembled here and sold to the rest of the world.
Malaysia's semiconductor production, a hardware vital in powering AI systems, has been steadily increasing. Output has more than doubled since 2014, reaching more than 35 billion semiconductors in 2023. Last year, the Malaysian government launched the National AI Office to oversee AI adoption in a range of sectors, from transport to healthcare. And this year's budget doubles down on AI technologies, allocating a record $98 billion in total. Of that, $140 million will go towards areas like enhancing AI in education, research and development, while more than $67 million will fund AI startups.
We are looking to build a complete supply chain in advanced industries, such as AI data centers, AI data servers, autonomous vehicles, IoT, robotics, and other verticals. An ecosystem perspective also means that we will prioritize local players as the first resort for every part of the supply chain.
Big companies are flocking to Malaysia to secure a foothold in its chip industry. In May last year, Microsoft agreed to invest $2.2 billion for new cloud and AI infrastructure in Malaysia. The project will also train 200,000 Malaysians in AI skills. Emre Boz, TRT World.
Well, let's get more on this now with Ibrahim Sufyan in Kuala Lumpur. He's the director of the Merdeka Research Centre. Really good to have you back with us, Ibrahim. It really does look like Malaysia is looking to be the regional leader in AI. Of course, China to its north is the overall AI leader in Asia. But what role do you think Malaysia can play in terms of perhaps partnering with China and other countries?
Well, Malaysia hopes to lean on its 50 years of experience in making chips, testing and assembling them, and leverage on that experience in partnerships with other firms and countries to develop its own in-house capacity to design and build and assemble its own chips. So this is the country's ambition. It is a long-term ambition, and that has been outlined in the country's national semiconductor strategy that was unveiled around November last year. And the goal is to basically complement the other countries that are providing the know-how and also expand into new markets that are currently untapped, presumably in the global south.
Well, that's right, because we know that the US and China are currently competing for AI dominance. And meanwhile, we've got countries like Malaysia really looking to develop a regional focus. So how will that strategy work, do you think? Do you think that by addressing countries in the global south, that perhaps it can dominate a particular region instead of trying to compete with the likes of the US and China?
Yeah, I think Malaysia's goal is actually to try and build its own internal capacity and then get a share of the market. As things currently stand, Malaysia contributes perhaps it's number 6 or 8 in terms of the overall market share in terms of chips production. But in terms of domestic capacity, most of its competency rests in the back end elements, which is testing and then assembling. Malaysia hopes to climb up the value chain, design its own chips that can fit into its own industries as well as others. At the same time, Malaysia is hoping to further capitalize in the trade tensions between the US and China, hoping to attract companies and factories to assemble their products in Malaysia and then sell them to the other markets and potentially circumvent some of the sanctions that are taking place. And while doing that, also boost its local capacity, not just to be an assembler, be a place of second resort, but also make it smart and develop its own chips and capacities.
Yes, because partnering with existing global chip makers, chip designers is obviously one key aspect of this AI race. But I'm wondering, developing local knowledge is also another aspect to that race. Is there a push in Malaysia right now to educate its own people in terms of perhaps entering the AI industry in various roles?
Yes, certainly. I think the government has made it very clear that the AI is the next revolution in terms of industry, in terms of knowledge market, and they are basically putting resources there. From what I learned in terms of government documentation, Malaysia is prepared to spend upwards of $125 billion in the next 6 to 8 years in order to develop its own capacity. At the same time, there are granular changes that are happening internally. The government is changing its education policy. It is emphasizing STEM for students in school. So they see this as a long-term process that builds competency, not just in terms of export markets, but also ensuring that Malaysians can enter into the workforce, can provide quality and intelligent inputs into the industry. So this is a whole of nation effort from what we are observing.
And Ibrahim, I'm wondering, how would you compare Malaysia's efforts with other countries in the Southeast Asia region? Is it currently the leader in terms of AI, or do you see other countries in Southeast Asia looking to emerge as a key player?
Well, I think different countries have different competencies in the region. I would say Singapore has a strong presence in terms of the knowledge aspect of things. We understand that the Singaporean government is going to invest in wafer fabrication and so on. Malaysia is now hosting a large number of data centers. By the latest count, at least 35 data centers will be established over the next couple of years, and more to grow over time. And this is to take advantage of tax incentives, abundant electricity and water supply. Another country that I think is emerging as a strong player in the global overall semiconductor market is Vietnam. Vietnam too is pushing into this area, attracting investments. So I think in the context of Malaysia, it does have competition, but it also has strength in terms of its long-term experience in chip making, and also a large and fairly well-trained workforce that is also multilingual. So it's hoping to leverage on all of that and its trade links in different parts of the world.
This certainly is a very competitive space right now. Ibrahim Sufyan, we'll have to leave it there. Thanks, as always, for joining us on the program.
Thank you.
And that is all of your business and finance news for now. Thanks for watching. Bye for now.